Hi, this is George Tagnino, and this is a video about managing risk now as of April 28, 2020. In previous videos, I gave some ideas on how to manage risk. On this video, I'm using a different tack, and it's to show you how to manage risk using investment models and how to use them to profit from them. I will show you the performance data of 6 different model portfolio, a defensive portfolio using 6 ETF, a more aggressive portfolio using also 6 ETF. I will show you also the performance of a diversified portfolio being overweight with utilities. I will then also show you the performance of a diversified portfolio like the S&P 500 when you overweight with treasury bonds. And I will also show a diversified portfolio overweight with both treasury bonds and utilities. By looking at their performance, we can learn a lot, believe me, a lot about managing risk. I will show the performance of these portfolios since 2008, and I will use the following parameters, which are computer, of course, generated, and they will show the compound annual growth rate, which is the annualized growth rate of the returns. What has been the largest losses of this portfolio, considering that there have been 2 major bear markets and plus other corrections, pretty sharp corrections. The standard deviation, that is, what is the volatility of the returns, how big swings in returns you had in each portfolio. And another one, just to make things a little more useful, is what is the worst year in terms of losses. As I showed in previous videos, the business cycle is the main tools available to investors to manage risk. I'm going to show you the performance of 2 portfolios. One is a defensive and the other one is aggressive. The defensive portfolio uses mostly ETF doing well in this part of the business cycle, which we have been since 2018. The other ETF is called more aggressive because it's using ETFs, is skewed towards ETFs that are doing well during the period of strong growth and do poorly during this period. I'm going to show you first what is in the table, then I'm going to discuss the numbers in another slide. The numbers were obtained using models using equal weight, that is, an equal amount of money in each ETF. The buy and sell rules are based on the 200-day moving average at month end. In other words, if the ETF is above or at the levels of the 200-day moving average, is a hold or buy. If it is below the 200-day moving average at month end, please, only at month end, the last day of the month, then is a sell. Here are the 6 portfolios I showed you. This is the defensive, the more aggressive. This is using a diversified portfolio with overweight in bonds. TLT is a long bonds, treasuries. This is overweight in XLU. This is a diversified portfolio like SPY, an average, using overweight in TLT, bonds, and utilities. This is our long-term technical model. It's not needed to discuss it here. And this is the performance of the S&P 500 buy and hold. The test has been done from January 2008 to March 2020 at the end of every month. This is the balance of the portfolio as of March 2020. This is the return of $10,000 invested in January 2008. This is the compound annual growth rate of the portfolio, the annualized rate of return. This is the maximum loss that the portfolio would have had. Again, remember that from January 2008 to March 2020, we had 2 major declines plus some substantial volatility in 2015. You have the maximum loss. You have the standard deviation, which is the volatility of the portfolio. what is the worst year, and then this is the return on a shorter term basis from January 2019 to March 2020. I forgot to say that when you sell, you just put the money in cash. It's not reinvested. Now, what this chart has two important lessons here. One is the difference between the defensive and aggressive performance of the two portfolio, and the other one is the importance of adding utilities and bonds to a portfolio. Let's look at the defensive versus aggressive. As you notice, the returns for the defensives is lower than the 9.5% of the more aggressive. However, the aggressive has more losses because it has more volatility. As you can see, 9.8 standard deviation. The defensive has only 7.4% max loss and much lower volatility, 6.9 instead of 9.8, and much lower worst year. So the defensive is true that gives you more peace of mind, but it also shows that you have over the long term lower returns. Since 2019, when the markets have been highly volatile, the defensive stock has outperformed the aggressive by a pretty wide margin. So this is an important issue that each investor, each of us has to resolve. What do you want? You want the aggressive, a lot of performance but higher volatility, or the defensive that just sails through the market returns and gives you peace of mind. Now, the other thing that this chart is showing that is also a great lesson, I think, at least for me, is that the use of bonds and utilities. And as you can see, here is an average portfolio. I say SPY is an average portfolio. If you have a diversified portfolio, the odds are you're going to perform like SPY. So if you increase bonds or you increase utilities, as you can see over the long term, the two portfolio behaves like the same way, 8.3% average return. The loss is about the same. The bonds show less volatility than the portfolio using utilities. And again, even here, the worst year lost less than the portfolio using utilities. Since 2019 to March 20, the portfolio emphasizing bonds has outperformed by wide margin the one performing utilities. So what I said is, well, what happens when you add bonds and utilities together to an average portfolio? The performance is still the same. The performance is still the same. You lower the maximum loss, as you can see, is 7.7% instead of almost 9%. The volatility has decreased, and the worst year is about the same, 5.4%. The return, however, since 2019, which has been highly volatile market, is an interesting and very attractive return, especially when you see compared to the market, which has been 4.6%. What is the point of this chart? Well, the decision that each of us has to make, you want a defensive portfolio emphasizing ETFs or sectors that do well in a slowing down economy, and you just keep, even in a strong economy, you keep the same ETFs using, of course, this rule here. Or you emphasize your portfolio and you put more aggressive ETFs doing well when the economy is strong. Or the other issue raised by this study is that the use of TLT and XLU, that is utility and XLU, when you overweight the portfolio with utilities and bonds, you come up with a portfolio that has considerably lower volatility than the return on the market, and has provided a return of 8.4% versus 6.9% of the market, with much lower loss, 7.7 instead of 48, 6.5 standard deviation instead of 15.5, which means the portfolio is considerably less volatility, and the worst year 5.4 instead of 36. So it provides a hedge against losses, and it is provided in a very uncertain times provides a return much higher than a diversified portfolio. Now, one of the things that is important, this study is not if you do it and follow these rules, this is what you will get. But using models, you will learn, hopefully, how portfolios perform when you add more bonds or utility, when you use a portfolio, defensive portfolio over the long term versus a more aggressive. So it gives you the parameters. But obviously, if you're asking, is this what I can expect in the future? No one can say that. But this is what they have done in the past, and I think they provide a very interesting lesson for investors. Quite frankly, I follow very closely the lessons learned by these portfolios. This is the performance of the portfolio when you add to a diversified portfolio like SPY, you overweight in TLT, which is the ETF for long-term treasury bonds, from 2007 to 2020. And as you can see, there has been several downturn, and downturn, but this portfolio was pretty smooth, very low volatility, has been able to sail through, except for this period here, but has outperformed the market. This is buy and hold, the S&P 500. The portfolio value is here. This performance, by the way, performance is updated every month at month end, and it follows the 200-day moving average timing that we talked about in a previous slide. This is another example of a portfolio which is updated monthly on in our service, the Peter Deck portfolio, and is the aggressive model. This portfolio is using mostly ETFs that do well in a rising business cycle phase. Now, the interesting thing here that the performance of this portfolio, the blue line, has been much better than the previous one when we used the bonds. However, notice how the volatility is much higher. In other words, increasing risk, what you see is volatility rises. But this portfolio has outperformed the market by a wide margin. This is the S&P 500 buy and hold. Notice how the 200-day moving average rule avoided this portfolio to lose a lot of money. Here, however, lost money, here lost money. But again, this is part of the volatility. The problem with this kind of volatility that it's very easy for investors to stop following what the model says because they're taken by emotions and say the model doesn't work. But eventually, over the long term, this portfolio seems to have worked and especially has avoided big losses here and here, of course. The importance of using successful models, this to me is very important, is that the major overwhelming advantage of timing models is to considerably reduce the volatility of the portfolios and the size of the losses compared to the buy and hold strategy of the S&P 500. They offer an unbiased and quite successful risk management tool. The main issue, as we said before, for the investors is to stick with the model, not to overwrite the model. As soon as you overwrite the model, the outcome of the model is totally false and is not true anymore. These and other models are updated in each issue of the Peter Deck portfolio. And by the way, they are discussed in details in my two books, Easy Ways to Beat the Market with ETFs and Investing Wisely, Is It Easier Than You Think? This is just a reminder that you can subscribe to the Peter Deck portfolio, which is published every week on peterdag.com. First month is free, and then I publish 3 books. I wrote 3 books that are available on Amazon.com.